Thank you for watching this video. Today we will be doing technical analysis on the stock market for the week ending Friday, February 26th, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. So the first chart that we're going to look at is a 5-day, 15-minute candlestick chart of the S&P 500. I wanted you to see this week and all of the volatility. So this is just the last 5 days of trading, and we can see that on these 15-minute candles, we closed right near the lows, not at the lows, but right near the lows of the session today on Friday the 26th. And for today, we were down 48 basis points on the S&P 500, and we did hit this week's low just before 11 o'clock this morning. So, it just a really rough week, but the fact that we closed beneath this blue line, which is set at 38.20, and you're going to see that that 38.20 level has been a very important support and resistance level for a good portion of 2021 so far. So the fact that we closed near the lows of the session and underneath that 38.20 level could mean that there's more selling coming our way next week. The next chart that we're going to look at is an hourly candlestick chart of the S&P 500 going clear back to the end of 2020. So this area where my cursor is moving, that is December 31st. The reason I wanted you to see this chart is that it contains every hour of trading in the S&P 500 for 2021 so far. And what we can see here is over on the right side of the chart where my cursor is moving, underneath this blue line, again, that's that 38.20 level that we just talked about. And you can see this 38.20 level, well, you can see for this week, right, it had acted on these hourly candles as a support area until the last hour of trading today on Friday the 26th. So you can see on the hourlies for this week, 38.20 had held up, right? We had some trading beneath 38.20, but no hourly closes beneath 38.20 until right here. So this tells me that there's still some weakness in the market, and it's possible that we will see more selling next week. Only time will tell, but this isn't good. Now, we can see that this 38.20 level, and I want you to understand the importance of this, so stick with me here. You can see that 38.20 had acted as an overhead resistance area for several days during the month of January, and then acted as support towards the end of January. Of course, we broke down beneath that, checked back to the 3,700 level, this bottom blue line, and then bounced off of that right at the beginning, first trading day of February, rallied our way back up to 38.50 where we got rejected, and we've been selling off since. But again, the fact that we closed beneath 38.20, guys, there's just not a ton of support. There might be a little, but there's just not a ton of support below 38.20 until we get down to 3,700. So the fact that we closed, at least on the hourly candles, at the lowest level that we saw this week on the hourly closes, that is not a good sign. And again, the fact that that hourly candle closed beneath 38.20 tells me that it's very possible that there's going to be more selling next week. The next chart that we're going to look at is a 6-month daily candlestick chart of the S&P 500, and the green line is the 50-day moving average. The blue line down here, that is the 200-day moving average. One of the things that's really interesting about today's trading is it stopped almost exactly on the 50-day moving average. You can see that we closed at 38.11.15, and the 50-day moving average is at 38.08.40, okay? So we stopped just a couple of points above the 50-day moving average. We stopped at the 50 on the daily candles back towards the end of January. It is possible that, the worst is over, and that even though we undercut that, 38.20 area, the fact that we stopped right at the 50-day moving average, it's possible that next week, just like we did right here, that we'll bounce off of that 50 and move forward. That is always completely possible using technical analysis. However, these markets have been running really hot, guys, and there's things that I see within my proprietary model that tell us that it's, again, possible that we will see further downside. So any of you that are Simple Market Signal subscribers, you know exactly what I'm talking about based on some of the signals that we've had this week. If you're not yet a subscriber, I'll talk more about Simple Market Signals at the end of this video, so stay with me, and I'll tell you how you can get involved. But the fact that we stopped right at the 50-day moving average, that is at least encouraging. And of course, on the weekly chart, as we see here, this is a 3.5-year weekly candlestick chart of the S&P 500. The green line is now the 10-week moving average, which of course is equivalent to the 50-day, and the blue line is the 40-week moving average, which of course, excuse me, is equivalent to the 200-day. So again, we stopped right at that 10-week moving average. Of course, that's equivalent to the 50-day, and we were down 2.45% for the week on the S&P 500. So, when you go back and look at a chart like this, it feels really bad, right? I mean, it's scary, and we closed beneath some short-term support areas, which tell us that it's very possible we'll see further downside. But when you look at these longer-term charts, whether it's the daily or the weekly, we can see that all we really have done so far is pull back to that 50-day moving average. So, if we're lucky, this is as bad as it gets. However, guys, look at down here, right? Look at where that 200-day moving average is. It's down around the 3450 area. So if we are pulling back to the 200-day or the 40-week moving average, we've still got a ways to go, okay? And you can see when you look back over the last 3.5 years, it's not uncommon at all to pull back to this 40-week moving average or drop below it, right? It's very common, right? Several times a year in most years that you're going to pull back to that 40-week moving average, at least temporarily. So if this is the start of us pulling back to this 40-week moving average, we still have quite a ways to go. Also keep in mind that this is the first time in many months that we've had 2 negative weeks in a row in the S&P 500. The last time we had 2 negative weeks in a row in the S&P 500 was back here. That's back in October. So it's been quite a while since we've seen this. It's not necessarily a good sign. You can see that after we had those several weeks where the S&P 500 was negative in October, then we bounced right back. And really since the beginning of November, we've been on an absolute tear in the overall market here. So we shouldn't be surprised, right, because we've come a long way in a very short period of time. We shouldn't be surprised to see this. But it will be extremely critical next week for us to stay above this 50 moving average. If we don't stay above the 50, keep in mind that 3,700 would be that next stopping area, and from there, then we're probably looking somewhere down around 3,510. There's some support right there. But if 3,700 doesn't hold, guys, then probably that the 40-week moving average, which right now is setting around 3,450, that would be the stopping place, with the fingers crossed that it doesn't get any worse than that. Okay, so with that said, guys, if you saw my video from last night, or if you've been following me for any length of time, you know that stocks and bonds are selling off together. Traditional allocations are not working. I don't see that changing anytime soon. Trading and investing is as hard now as it's been in a long time, and perhaps even ever. Okay. And any of you that are old enough to remember or were trading or investing back in the 90s, there are things about this market, guys, and I've been at this a long time, all right? I've been trading and investing for over 3 decades. This reminds me, there are things about this market that remind me of the late 90s, okay? So let's not get overly confident and too complacent or cavalier, all right? And as much as I love traditional technical analysis, guys, it's somewhat incomplete, all right? Where I'm going with this is, please, you need to have a system, a risk reduction system, but something that helps you in both up and down markets, all right? It's not just about protecting yourself on the downside, which is super important, but it's also about understanding when the markets are amenable to you being pedal to the metal, right? When is the market right for you to have your maximum equity exposure, whatever that means to you, whether it's a 60, 70%, 80% allocation to equities, 100% allocation to equities, 150 to 200% if you're using margin. If you're using margin, of course, be super careful, especially in this environment. But you need a model, a risk management model, if you will, that helps you understand what mode the market is in and whether you should be stepping on the gas or stepping on the brakes. All right. I spent over 20 years of my life developing a system like that for myself. Once I realized back in 2017 when it finally came together for me, once I realized what I had, I realized I could help a lot of people with this. Okay. And remember, I'm a former financial advisor. I love helping people. I'm also a businessman. I like making money for myself. So with that said, I built a business around my model. It's called Simple Market Signals. Guys, it's super affordable. All right. It's less than 67 cents a day. Let me get that out there right away. So I spent over 20 years of my life putting this model together. I would encourage you to spend the next 15 to 16 minutes of your life watching the balance of this video to see how Simple Market Signals, my system, and becoming a subscriber and working with me to see how this could help you, okay, in both up and down markets, guys. It's not just about, helping protect you in a down market, which it will if you use the signals properly, but it's also about helping you understand when the market is right, when the market environment is right for you to have your maximum equity exposure, again, whatever that means to you, okay? So, guys, thank you. Please pay close attention to the balance of this video, and I will talk to you soon. Let me ask you a question. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases, and then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's two major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors, and what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors. And what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how Simple Market Signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. We had a strong stock market coming into 2020, so the risk signal was green coming into 2020 and remained green for the majority of January. We did have a yellow signal for about 2 weeks towards the latter part of January, first part of February, and then, of course, the risk signal went back to green. And then on February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th. and then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow, and then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model during the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500. In 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how simple market signals could have helped you during that time. With simple market signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market, and it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The best fit for simple market signals is an investor or a financial professional with at least a 6 to 8 week plus time frame that they're focusing on. If you're a shorter term trader or a day trader, simple market signals may help you a little bit, but the reality is that the best fit between simple market signals and a subscriber is somebody that has at least a 6 to 8 week time frame or more that they're focusing on. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts, and this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios, and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an emailed newsletter, so we will have to have your best email address on file, and make sure this box is checked, because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. A few points to remember with respect to your subscription to Simple Market Signals. Remember that everything is tied to your email on file. Now, once you subscribe, you will get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter, so that's automatically generated from our system. And whether you see that welcome letter or not, I would encourage you to double check your spam, junk, trash, and promotion folders, especially for the first several weeks of subscription, because once in a while, our emails get automatically routed into one of those different folders depending on your email service provider, whether it's Gmail, Yahoo, whatever it may be. And I would get in the habit, I would encourage you to get in the habit of every week or two, just go out real quick and double check these different folders, the spam, junk, trash, and promotion folders, because I can't even tell you how many times I've had people say, well, I didn't get the email, and then when I tell them to go out and check those various folders, oh, there it is. So it's just, the reality of having an emailed service that once in a while, and it's going to vary from email service provider to email service provider, but once in a while, the emails from us, depending on the subject line and other things, will get automatically routed into one of those different folders. Also, I would encourage you to whitelist all emails from Simple Market Signals. In other words, just make sure that your email service knows that you want all Simple Market Signals emails to go to your primary in basket. Also remember that newsletters go out on the weekend, okay? They generally go out Saturday afternoons, but they could go out anytime over the weekend depending on our production schedule. And the next new edition will be sent to you on the weekend following your subscription. So if you subscribe on a Monday, Tuesday, Wednesday, whatever it is, the next new edition is going to come out on that weekend following your subscription. But we will also send you the latest edition, so whatever the most recent edition of our newsletter was, we'll send you that latest edition as soon as we can, but we have to manually send that to you. Generally, you will receive that within 24 to 48 hours of your subscription. So again, if you don't see that first newsletter within 24 to 48 hours, go back and double check your spam, junk, trash, and promotion folders to make sure that it's not hidden in there. Also, within that first 24 to 48 hours, we're going to send you at least one or two emails with links to training videos that are for subscribers only. So please make sure that you're looking at all of this, because it's extremely important for you to get the most out of your subscription. Please watch those videos that are part of the training material that we send you. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly emailed newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.